Hey there! In today's video, we're going to talk about a financial wizard, an investment guru, the one and only Peter Lynch. From 1977 to 1990, Lynch achieved a staggering 29% annual return, managing the Magellan Fund at Fidelity. His book, One Up on Wall Street, is considered a must-read for any investor, even today. So why are we talking about Peter Lynch in 2023 anyway? Well, we all know that the business cycles can be unpredictable, and right now, we're dealing with some major issues like high inflation and rising interest rates. These problems have been causing asset prices to suffer, and it looks like they're going to be around for a while now. And that's why we're turning to Peter Lynch for some timeless investing advice. In this video, we'll dive into Lynch's thoughts on investing during times of inflation and rising interest rates. Be aware though, the comments you are going to hear were from Lynch a long time ago, but you might be surprised to learn just how relevant his ideas are for the challenges we're facing today. So buckle up and get ready to learn from one of the greatest investing minds of all time, Peter Lynch.
You'll understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's, has done very well as a company,
right,
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, who's the president, who's being nominated for the Supreme Court,
it's all
the
earnings.
ozone layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
So here is key takeaway number 1 from Peter Lynch. Don't focus on the macro. Right, you may think, but those other factors will impact or influence the price of a company. If you look at the financial news today, it is all about macroeconomic numbers, GDP, CPI, unemployment rate, etc. They can move the markets in a huge way, so how can we simply ignore them? Well, here is Lynch's response.
Very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to
He
tell
can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years from now. He's even surprised how low they are now. So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of 82.
Yes.
In 1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about these things.
As investors, we need to avoid getting caught up in short-term macroeconomic factors that we cannot predict or control. While these may influence stock prices in the short term, our focus should be on evaluating individual investment opportunities on their own merits. It's like trying to predict the weather. It can be interesting, but ultimately it's out of our control and doesn't tell us much about the long-term prospects of a company anyway. Instead, we should be spending our time doing deep research, analyzing financial statements, and staying up to date with industry trends to make informed investment decisions. Don't let the noise of the media distract you from your ultimate goal of building a solid, long-term investment portfolio.
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, there can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. But I'm trying to tell you it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, our interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
Trying to predict and control macro factors is like trying to catch shadows on a stormy night. It's a fool's errand, and let's be real here. Who has time for that anyway? The media might love to stir up drama around macro issues, but we need to stay focused on what's truly important: solid fundamentals and thorough company analysis. If we can maintain a laser-like focus on these factors, we can build a portfolio that's immune to the volatility of the macro world. That's right, we can be like superheroes with the power of sound investment strategies. Which brings us to key takeaway number 2 from Peter Lynch. Focus on the long term.
Right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. That's the kind of numbers you're interested in. Betting a 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
Picture this. You're at a carnival and you see a group of people gathered around a booth where they're guessing the weight of a giant pumpkin. The crowd is buzzing with excitement and everyone is placing their bets. The prize, a measly stuffed animal. Now imagine you're trying to do the same thing with the stock market. Financial professionals are like those carnival workers, trying to guess what the prices will be tomorrow. But in reality, it's pretty much pointless. The stock market could go up, down, or sideways. It's like trying to guess the weight of said pumpkin. When it comes to stock investments, we the investors have an edge that lies in the long term. Over the next 5, 10, or 20 years, the likely outcome of the stock market becomes much clearer. Businesses become more productive, thanks to new technology and innovation. Their earnings increase and stock prices tend to follow suit. Just take a look at the historical S&P prices over the last few decades. Despite some dips and dives along the way, the overall trend is up, up, and up. And that's what we're talking about here. So, let's stay focused on the long term and keep an eye out for those companies that catch our attention. Look for the ones with solid fundamentals, competitive advantages, and well-oiled management teams. And most importantly, make sure they offer a steep discount to intrinsic value. Cause everyone likes to shop when things are on sale, and it's exactly the same for the stock market as well. That, my friend, is key takeaway number 3 that Peter Lynch has to offer for investing in 2023. Invest in companies with a buffer zoom. So let's hear that again, the words of wisdom for just that exact scenario.
You say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. You say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own it.
So investing in current market is like finding those hidden gems. The companies that have great potential but are also undervalued. Let's say you've done your research and you've calculated that a stock is going to grow by 10% per year for the next 5 to 10 years. And you've estimated that the stock is worth $30 today based on future earnings. Now, if the stock is currently trading at $30, then that's not really a great deal because the company has to execute perfectly to meet your expectations. What we're really after are the stocks that you've calculated to be worth $30 today but are actually selling for $20, and that's when the risk reward is in your favor. This is what Peter Lynch was talking about. Finding those wonderful companies that are undervalued and seizing the opportunity of market weakness. So get ready to dig deep and discover those hidden treasures for yourself. So those are the 3 concepts we can leverage from Peter Lynch's wisdom to make better investment decisions in 2023. Number 1, avoid paying too much to the macro. Number 2, focus on the long-term horizon. And number 3, look for good companies that are trading at a discount. Lynch's emphasis on focusing on the fundamentals of a company and not getting caught up in macroeconomic factors is just as relevant today as it was in the past. By following his advice and doing thorough research, we can make sound investment decisions that will stand the test of time. Thank you for watching, and if you have any questions or comments, please feel free to leave them down below. And don't forget to hit that subscribe button and the notification bell so you never miss out on any of our future videos. Happy investing! More content to follow.